Hey, if you want to be successful in commercial real estate, whether as a broker or owner or investor, there's some must-know commercial real estate finance terms that you need to know. And if you don't, stick around because I'm going to teach you what those are in this video. What's up, everyone? It's Tyson here, commercial real estate broker and owner. And this is a show where we talk about everything commercial real estate. In this episode, we're actually going to break down some finance terms. These are super key commercial real estate terms that you probably hear a lot. You may not know, but if you don't, hopefully in this video, we're gonna break them down super easy to understand. And at the end, I'll share how it all works together so that you can make the best decision when underwriting any commercial real estate property, specifically multifamily or parks. So let's jump right into it. The first one, probably the most used and probably the most common, is cap rate. In the simplest form, it stands for capitalization rate. Basically what cap rate is its NOI divided by cap rate equals price, okay? The simplest way to put cap rate, if you paid cash for a property, the return on that cash would be the cap rate. So the simplest example would be if you bought $1 million property, you paid all cash for it. If you generated $100K per year, that's a 10% return. It's also a 10 capitalization rate. It's basically the NOI divided by the price equals the cap rate. Okay, so $100,000 divided by $1 million is 10. Here's what cap rate really means though, and you hear cap rate being thrown out there because brokers like myself, we use it as a metric to determine value. And so you've seen cap rates compress as demand rose, especially in multifamily, especially in mobile home parks. Cap rate is really also a metric to determine risk or the amount of work that property might entail. For example, the riskier or the more unknown a property could be, generally you're going to see a higher cap rate, which means you would generate a higher return. And the reason is you're going to expect a better return for a riskier or more labor-intensive property. And so as things were in the past, especially with mobile home parks, we used to see cap rates super high. People didn't really know what they were. They generally assumed that they were probably a more risky investment. You couldn't get great debt on them back in the day. Therefore, the cap rate was higher to compensate for that. Cap rate is also a metric that we use to assign value, and we use it to determine similar values. So cap rate's a metric that we can use when evaluating markets. Cap rates, we hear that term when we're talking about what's that property worth, what's the cap rate. That can really tell you whether the property's priced right if cap rates are similar, or if you might see a high cap rate, there might be something wrong there, it could be underwritten incorrectly. But generally cap rate is a metric that is used universally in commercial real estate. One of the issues I have with cap rate is that depending on how you underwrite your property, that is what kind of expenses you use and income, can have a big swing on value, even if you use the same cap rate. For example, in our previous example, we used $1 million property, right? That was because we were generating $100,000 in income. Well, let's say that I'm assuming that your expenses are way less because I omitted management, right? I'm an owner and I'm saying, hey, you know what? You should manage this park. So that's 15 grand, right? That you wouldn't have as an expense. And there's no landscaping. So instead of 100 grand, you're gonna make 120 grand a year, okay? So using the same cap rate that we did before, the 10 cap, all of a sudden that value is worth 1.2. That's a $200,000 swing using the same cap rate, but the difference is that one owner thinks the income is 120, the other owner thinks it's 100K. That's where things get messed up, and you'll see that a lot in broker pro formas. One broker's pro forma could be totally different based on their NOI because their expenses are different. Cap rate could be the same, value would be different. So be super careful with that. Next is NOI. I already mentioned it, but it's the net operating income. The NOI, or the net operating income, is basically the gross income less all of the expenses, okay? And we would include property taxes and insurance in that. So net income, gross income, again, gross effective gross income, that would be any of the rental income plus any ancillary income. And we're gonna minus all the expenses, property taxes, insurance, maintenance, payroll, landscaping, utilities, all of that comes out, you're left with net operating income. That's the number you use to determine value. After that, what we have is cash on cash. A lot of people like this metric. Super easy to evaluate whether or not it's a good deal for you. You know, when I look at deals, I look at cash on cash. It's one of the things that it's important, right? Cash on cash, simplest way to put it is whatever the money is that I put into the deal, and the cash flow that comes out of it, right? Whether it's I put debt on it or not. Let's say I put $500,000 down, I get a loan, I buy a property, and then it spits out $50,000 in income, cash flow every year. That's a 10% return. That's 10% cash on cash, right? So 50K divided by 500. Super simple math. Hope you guys got that. If you didn't, I don't know what to tell you. Another term you hear a lot is LTV, loan to value. Loan to value basically just means the size of the loan to the purchase of the property. Basically means the size of the loan divided by the purchase price of the property. So a lot of times lenders look at 60 to 70% LTV, loan to value. So if you get $1 million property, they're gonna give you a loan of 600 to 700K, right? 60 to 70% of that price will be the LTV. Another one that you don't hear as much, but lenders like to look at it, LTC, it's a loan to cost. So what is your total cost to the property? So it could be the loan plus additional cost that goes into the loan, maybe loan fees, things like that. That's your LTC. So again, that's just the same metric, the loan amount to the total cost of the property. Here's one of my favorites, get ready for it. A lot of people miss this, I hope you don't. Debt service coverage ratio. It's one of the key factors to determining a value property or a price that you can pay for a property. Here's how we break this down, okay? The NOI, it's the net income that the property makes. Once we establish that, we know at the end of the day, if we get all the rent collected and we don't have any evictions or trouble people, we got everyone that's paying, it's generally not the case. We take all the expenses away and we have that net income. Well, then we've got to make sure we have enough money to pay the debt. And the debt service coverage ratio is that spread, okay? It's the spread between the net income and the debt payment. Lenders like to see at least a 1.2 debt cover. So what that means is if you take the NOI and you divide it by the debt, there should be at least a 1.2. That's the bare minimum. And so if you're underwriting a property and the price that they're asking with the debt terms that you know that you can get, if that spread is less than 1.2, there's only a couple ways that you can make the deal work. Number one, you can lower the price, right? Go back and offer a lower price if you want to keep that down payment the same. You're like, hey man, I only got 25%. I'm not putting more than that, right? 25% or I don't do the deal. Well, the only way you do that deal with those loan terms is you lower the price, right? So that becomes a higher debt cover spread. Or if you're like, hey, I'll put more money down, then you can get a lower loan amount, right? So lower loan amount is gonna be a smaller debt payment. We'll increase that spread. I can't tell you how many brokers don't know how the debt affects the value. It's super crazy to me. You guys gotta figure it out. Debt affects the value. And so that doesn't mean it's gonna dictate value at all, right? I'm not saying that, but it does affect it. So you gotta know how that works. Debt service coverage ratio, make sure you know that. Those are the most important that most people are going to deal with. There's some other metrics that more institutional groups use like IRR and some other things. But for the sake of this video, if you focus on those key metrics, you're going to be off to the races. You're going to understand how to look at a deal. And so again, go back and look at those. If you understand all of those, you're going to be better off than a lot of investors. If you have questions on that, go check out some of the other videos where I break down how to underwrite a mobile home park in 10 minutes, super high level. It's not in depth, but we can get into in depth in a future video. And guys, appreciate your time. Love that you're watching these videos. If you find them helpful, shoot me a message. We're gonna have a contact info below and share with somebody or like, and take care. We'll talk to you soon.